The markets are providing fertile ground for risk-taking in equities and emerging market assets. That's one of the opening quotes from BlackRock's fourth quarter investment outlook. Karim Chedid is with us now from BlackRock, from the investment team there. Good morning. Bullish fourth quarter. Well, we've already started out in the fourth quarter and we've already seen records, of course, on Wall Street and in some of the European markets. But yeah, it's looking very bullish, is it?
Yeah, I mean, also I think Japan is at 1996 highs this past weekend. Excuse me. So bullish all around. We do think that the environment that we've had so far this year, with EM leading, EM equities up around 2.5 times the amount that developed markets have rallied. We do think that environment will continue. So it's a bullish environment, but bullish with the EM in the lead, which is not a surprise given the global growth picture is at an expansion level and is synchronized in multiple regions at the same time.
So what do you say then to people that say that valuations are already overstretched?
I think when we think about valuations, we need to rethink. Another thing we've talked about in the outlook is rethink your returns, rethink your risks. And what we mean by that is when you think about valuations on a price to earnings level, that's one dimension. But then given that we are in a structurally lower rate environment for bonds, we need to think about it at a second dimension. So valuations on a cross-asset basis, whereby equities do not look as expensive as you would initially think when comparing them to bond yields.
How low then can volatility go? Because that's one of the things that's been stirring interest in equities, and the bullish move has been because we've seen the VIX index at lows, I think record lows, is that right? How much lower can they go?
Yeah, I mean, VIX at lows and V2X, which is the European equivalent of VIX, caught everybody's attention this summer because it also dropped to record lows, even though it typically traded at a premium to VIX. That premium has nearly disappeared. So started as a US phenomenon and now also in Europe. I think rather than wondering how low volatility can go, we'd rather focus on what is causing volatility to be so low? And the answer is in the macro picture. Macro volatility is low, and that is the volatility of the GDP series, the volatility of inflation readings, as opposed to just the volatility of equities. Those are all really low. So long as that volatility, this volatility in the macro world is low, we don't see the volatility in equities changing.
So what are the signposts we should watch out for then that might change the outlook?
A great question, because ultimately this low volatility in the macro world could change, and that's what would cause VIX to spike in our opinion. The signposts are really any potential disruption to the global trade picture or the global economic picture. So it's not every geopolitical risk. Not every North Korea headline is a signpost for us. It is rather things like US-China relations. We watch US-China relations very closely because we want to see that the trade relations will remain strong, because that's what matters for the global trade and global economic picture. Another signpost is what's happening in the White House in terms of the debt ceiling negotiations to extend the debt ceiling in December even further.
So these are big picture events. How about some of the events that perhaps maybe markets are already priced in? Interest rate rises in the States. Can we be sure that's going to happen in the fourth quarter? QE for Europe, tightening of the QE program in Europe. Can we be sure other markets pricing in that beginning as well?
Yeah, so if I take them by timeline, the QE announcement from the ECB could happen in October. October 26th is the ECB meeting, and that type of taper announcement, in our view, is likely going to be on the light side as opposed to the heavy side. So it's going to be a taper announcement driven by the technical limits, the self-imposed technical limits that the ECB has around the government bond purchases because of capital key, as opposed to a very large taper announcement that is a huge sign of tightening. So we think the ECB will largely remain quite accommodative in spite of tapering. The Fed, however, as you said, the market is all but sure that there's going to be a rate hike in December because it's almost fully priced in. I would be very surprised. There needs to be a sizable shock for that not to happen. And so it's pretty much in the price. 2018 is less certain because the Fed is pointing to 3 more hikes then, but the market is only pricing in 1.5.
Much dependent, presumably, on whether or not this inflation that Janet Yellen is talking about starts to kick in.
Yes, the last reading we had was this past week, and that was a miss, a CPI miss, which is 6 out of 7 misses in the last 7 readings. That inflation picture has to start coming in for the Fed to comfortably move forward in 2018.
Yeah. Let's take a look at ETFs or ETPs, exchange traded products. Where are the flows going to go in the fourth quarter?
So the flows are largely still very risk asset driven. So we're seeing money going into equities more broadly. Primarily, it's been focused on EM equities, which is not a surprise because they're in the lead. That can continue. But what's interesting is Japan has started to come back in this past week ahead of the elections there on October 22. And the Japan flow picture this past week is very much foreign investor driven. So we saw $1.4 billion going into Japanese equities. Really impressive numbers after it had been missing from the picture earlier.
Even in the face of tightening money, because liquidity is not going to be as abundant, is it?
No, but the growth picture, so long as tightening is for the right reasons, i.e. responding to a positive growth picture, the growth picture can justify further re-risking in equities. In the fixed income space, I think demand would likely continue to go into exposures like inflation linkers, which are positioned to that pickup in inflation that you spoke about earlier. But in equities, it's pretty much the EM, now Japan coming back in, Europe equities.
Yeah. What about sectors? How do you break it down in that regard?
On the sector and factor front, on the sector front, we're seeing value in financials. So that's banks and insurance companies, but the financials call is primarily driven by the banks piece because of their positive linkage with a steeper yield curve. And then we're also seeing interest in tech. And on a factor level, it's really the value stocks and the momentum stocks. And those are stocks that are cheap or stocks that have already been winning and continue winning.
We talk as well to your colleague Rob Powell about thematic investing. Any indication of how the fourth quarter is going to treat the big picture investing?
There's room for thematics from a diversification standpoint. So these are the exposures that are diversified away from the cyclical market themes. So they're very structural. They're likely to play out over the long term. So the rise of robotics, the rise of innovative healthcare. These are themes that are going to play out regardless of what happens to the market cycle. So I think there's a place for them in Q4, but there's also a place for them in the long term.
Yeah, okay. All right. Well, Karim, thanks indeed for joining us. Karim Chedid is with us there from BlackRock Investment, taking a look at the remainder of the fourth quarter, which has started off, as you said, with record highs in the US markets. Some of the European markets are at levels not seen in many years. And also, of course, we've got that rise in the Japanese markets to levels not seen since 1996.